A little earlier when we spoke, the rand was oscillating just below that 7.30 to the dollar level. We're now sitting at around 7.33. So a little bit of volatility coming through for the local currency, given the fact that we saw the rand hitting 7.17 on Friday. A lot of risk aversion as well, but at the end of the day, there's still a lot of appetite for local bonds and local assets.
Yeah, that's an accurate statement. Looks like the rand's been trading in a range, at least for today, of around 7.25 to 7.35, starting off quite strong towards the bottom of that range, then moving higher, weaker, above to around the 7.34 level. Then we saw a sort of a stronger move in the bond market and the currency at almost the same time, a very rapid move back down to the sort of 7.30 odd level. It's now trading up again, yeah, but it's benefiting at the moment from that international appetite for higher yield at the moment.
Forward rate agreements pricing in an interest rate cut and around 90% chance of a cut. So that's quite extensive, I would say, James. Where do you see things going from here onwards? Because at the end of the day, there's many investors out there that say that the Reserve Bank missed an opportunity to cut rates at the previous MPC meeting. Do you think it's basically a foregone conclusion for now?
I wouldn't say a foregone conclusion. Nothing ever is at the MPC meetings. It's always closer to 50-50 in reality. But yeah, as far as pricing is concerned for the September meeting, markets pricing in around 60%, and in the entire cycle pricing in between 80 and 90%, as you say. So it's a really deep discounting at this point. And probably, you can't argue with that given what the international central banks are saying with regards to interest rates and where they're going to be going forward, their forecasts. It's certainly, as it was for the previous MPC as well, the window is there. If they do need to drop rates and feel that the stimulus is required, then that the window is certainly open for that.
Well, just taking a look at where to from here for the local currency, as we mentioned earlier, the dollar gaining ground, a lot of concern about the stimulus that has just been announced for the US economy. We've got the yen gaining significant ground, which is really a great barometer in terms of risk aversion in the markets. James, where to from here for the rand, given the fact that bond yields are getting lower and lower?
Well, I think it's still going to be influenced by the carry trade. As far as we can see, the appetite is still there for the high yielders. I think based on Tuesday evening's FOMC comments, where they said that interest rates and stimulus is still required for an extended period, we saw US Treasuries benefiting from that as a capital sort of preservation perhaps strategy, but also those guys are looking for the high yielders. They're looking to get the yields that South African government stock is offering, as well as the relatively stable and strengthening currency environment. So that should continue for some time. There's no reason to see it abating any time at the moment. So as far as currency levels are concerned, well, the range, as we say, is around at the short term 7.25 to 35, and at the moment it still seems to be strengthening, and the real thing to look at is the level of the euro. As we say, that the euro has been sold off against the dollar after the FOMC statements, coming down from 133 to where it is at just above 128. If you look at that and how the rand's been behaving, I mean, the rand should theoretically be a lot weaker on the back of the euro move. But if that euro starts retracing back up to stronger levels on the euro, we could certainly see a much stronger rand as well. It's difficult to predict, but it certainly looks balanced towards a stronger rand at the moment, even bearing in mind all the fundamental concerns that exist at the moment.
Well, James, it's quite interesting to note because we are starting to see a general rotation back into safe haven assets, and this is why we also see gold above that key 1,200 level, and many investors out there buying back into US bonds and, of course, buying back into the US dollar. It's quite interesting to note that most investors are going back to the currency, which is also one of the most uncertain in terms of what we can expect from future prospects. How do you see that playing out going forward? I mean, obviously there's going to be an interesting play between the austerity measures in the Eurozone and, of course, the Euro, and how that's going to play out with the stimulus measures that have been put forward in the US, and, of course, the impact that it's going to have on dollar depreciation or appreciation going forward.
Yeah, sure. I mean, Europe, let's face it, has been out of the picture, really. It's sneaking back in. But we had major concerns in the last few months about Europe, and all the focus at the moment is on the dollar. And certainly, the dollar strengthened this week. And it's as we're saying, it's the guys looking to preserve capital. So they're going into those dollar treasury bills knowing that although the yields are low, they're going to get up with their capital, given the risky assets and the risky investments that do exist in those markets at the moment. So yeah, it's interesting to see those treasuries, and in line with the FOMC's comments that rates remain low, those treasuries are just going to be underpinned, those yields, and they're sitting at the moment around sort of 10 years at 275, down 10 basis points since the start of the week. It certainly looks to continue, yeah.
Just looking at the investment strategies out there, because at the end of the day we are starting to see, as I mentioned, investors going back into a country that has not taken control of their ballooning debt problem. How do you see that playing out? Do you think that the dollar at the end of the day is still fundamentally weak?
Yeah, I mean, those debt levels in the US are serious and they're a concern, but being one of the world's largest economies, it is still, it's considered a safe haven, and it always will be. I mean, there's a lot of confidence in it compared to perhaps the situation in Europe. So yeah, the funds, although it looks fundamentally perhaps a little bit shaky, its status as safe haven remains, so yeah, no change to that perhaps.
All right, looking at the Chinese economy, we had quite a big trade surplus, really showing that imports are relatively weak, exports looking quite strong. Of course, a very big issue when it comes to the overall global economy, a very big issue for South Africa as well when it comes to the local currency and our manufacturing sector. But the manufacturing numbers released yesterday came in better than expected.
Yeah, that's it. I mean, we'll start with China, just looking at their numbers slowing down, and it looks like they've certainly made an efforts to slow down the Chinese economy. They've still got retail sales figures at 17.9%. I mean, those are still huge numbers. So although it's slowing, it's still a strong economy. The concerns for us is as their demand slows up, our potential to export base commodities to China reduces. So that's the main concern there. With regards, as you say, to our manufacturing numbers yesterday, they surprised the market, expecting 6.8 coming in at 8.8. If you dig deeper into that, it's pretty much a big base effect, really. I mean, Nedbank, we had our number at 8.4, our forecast. So, and basing that purely mainly on those base effects. But I think as far as manufacturing being 15% of GDP, it's as important as that is to get a real insight into what's happening. You'd need to look perhaps at the breakdown of last week's PMI numbers and look at that having improved as well, but still below the expansionary 50-point mark, coming in just below that. If you look at the new sales, those were contracting. Employment, importantly, also contracting, yet input prices going up. So I think that is a real concern, as highlighted at the last MPC, that employment is dropping, but the cost of employment in wage demands is increasing without that productivity at the same time. So I think the manufacturing, although a good-looking number, really was a base effect and not to be taken, too importantly at this point.
James, just touching on the point that you made about productivity, aggressive wage negotiations, which are currently ongoing at this point in time, administered prices also said to be quite a big dampener on the inflation outlook in South Africa. We mentioned yields heading lower and lower levels because of all this appetite, but at the end of the day, the returns when it comes to investing in South Africa are far better than that of most of the developed world. Do you think the Reserve Bank should just cut interest rates purely because it could assist the rand to weaken and perhaps dampen the appetite towards South African assets? Or do you think that the Reserve Bank should just keep to its mandate and, in other words, try and ensure that inflation stays in check?
Yeah, they've said that inflation is the basis of their monetary policy, but they're also more flexible now, looking at other areas. But at the last MPC, they highlighted that the real concerns were those wage demands, and that's still going on. We've seen strikes in the public sector this week. Those demands are still there. We've seen, as we say, the contracting employment numbers. So those concerns will be there. Can we cut rates at the moment? Yeah, I think given the international opinion on rates being lower for longer, with that opportunity or the window of availability to cut rates is open at the moment. We can do it. Perhaps it answers some questions. It also raises some problems. But yeah, it certainly might slow down the rand's appreciation, which is a concern for our export sector.